Your money-making broadcast starts now. Good evening, and welcome to the Global Edition. Markets closed mixed but resilient on Wednesday, May 14, as investors digested a fresh wave of inflation data, a massive strategic pivot from Ford, and continued tariff negotiations overseas. The S&P 500 edged higher, led by Ford's biggest single-day gain in years and broad-based strength in technology stocks. The headline number, the S&P 500 tracking ETF SPY closed at $742.31, up 0.56%. The Nasdaq Heavy QQQ posted a stronger gain of 1.06% to finish at $714.71. The Dow Jones Industrial Average was roughly flat on the session. But the real story today is a much more complicated narrative. On one hand, wholesale inflation just posted its biggest annual increase since 2022, raising the specter of a Federal Reserve rate hike. On the other hand, the technology sector is showing remarkable resilience, with AI-driven demand for semiconductors and cloud infrastructure powering gains that seem to ignore the macro headwinds. And then there is Ford, which shocked the market by launching a Tesla-like pivot into energy storage. Let us break down what happened, why it matters, and what you as an investor need to know. Let us start with the biggest single company story of the day. Ford Motor Company surged 13.18%, pacing the entire S&P 500. The catalyst was the launch of Ford Energy, a new subsidiary that will focus on battery storage and energy management solutions. Think about what Tesla did when it moved beyond electric vehicles into energy generation and storage with products like the Powerwall and Megapack. Ford is now attempting a similar pivot. The company is leveraging its expertise in large-scale battery manufacturing for electric vehicles and repurposing that technology for stationary energy storage. This is not a small side project. Ford Energy represents a major strategic pivot that could fundamentally change how the market values the company. For years, Ford has traded at a discount to other automakers because investors viewed it as a legacy OEM with limited growth prospects. The Ford Energy announcement changes that calculus. If Ford can capture even a fraction of the rapidly growing grid-scale battery storage market, the valuation math changes dramatically. However, because Ford surged more than 5% today, we do not recommend chasing the stock at these levels. The Ford Energy thesis is compelling, but the market has already priced in a significant premium. Watch for a pullback before considering an entry point, and focus on the long-term potential of the energy storage business rather than the short-term momentum. Now let us talk about the macroeconomic story that dominated trading desks this afternoon. The Producer Price Index, or PPI, for April came in much hotter than expected. Wholesale inflation jumped 6% year-over-year, the largest annual increase since 2022. This follows yesterday's Consumer Price Index reading of 3.8%, which was already above consensus estimates. The combination of CPI and PPI running hot has fundamentally shifted the market's expectations for Federal Reserve policy. The market is now pricing in the possibility of a rate hike, not a cut. Let me repeat that, the question is no longer whether the Fed will cut rates this year, but whether they might need to raise them. Kevin Warsh, the nominee for Federal Reserve Chair, addressed this directly in his confirmation hearing today. Warsh said the Federal Reserve must stay in its lane to maintain its independence. This is significant because Warsh is widely viewed as more hawkish than the current leadership. His comments suggest that if confirmed, he would prioritize inflation fighting over stimulating growth. Paul Tudor Jones commented today that there is no chance Warsh cuts rates anytime soon, reinforcing the market's repricing of the rate outlook. For fixed-income investors, this means bonds remain under pressure. For equity investors, it means the path of least resistance is higher for interest rate-sensitive sectors and lower for growth stocks that rely on cheap financing. And yet, technology stocks rallied today anyway. That disconnect is the most interesting part of this market. Technology continues to show remarkable resilience in the face of inflation and rate concerns. The narrative coming out of the semiconductor and cloud computing sectors is that AI-driven demand is so strong that it simply overwhelms traditional macroeconomic headwinds. Micron Technology has rallied 38% this week alone, driven by explosive demand for high-bandwidth memory chips used in AI data centers. Supermicro Computer gained 25% today, continuing its parabolic run. The broader story is that big tech capital expenditures are expected to top $1 trillion by 2027, with most of that spending directed at AI infrastructure. The media is now running with headlines like "Tech optimism overshadows inflation fears," and that is exactly what we saw in the price action today. The QQQ closing up over 1% while the Dow was flat tells you everything about where institutional money is flowing. This is not speculation. These are real capital commitments from the largest companies in the world. Microsoft, Amazon, Google, and Meta are spending billions on GPUs, custom chips, and data center capacity. The beneficiaries are companies like Nvidia, Micron, Broadcom, and the cloud infrastructure providers. For investors with a long time horizon, this AI infrastructure build-out represents one of the most significant secular growth stories in decades. On the trade front, there are major developments coming out of Asia. President Trump is in China, and traders are increasingly predicting a tariff truce extension. The negotiations appear to be progressing, with Boeing aircraft purchases reportedly on the table as part of a potential deal. This would be a significant positive for the industrials and aerospace sectors. Meanwhile, the toll of the existing tariff regime is becoming clearer. UK exports to the United States have plunged 25% following Trump's tariffs, demonstrating the real economic damage that trade restrictions cause. There is also a very practical development for US retailers starting Monday. Tariff refunds will begin flowing back to companies that overpaid on imported goods. Several major retailers are due significant paydays from these refunds, which could provide a meaningful boost to consumer-facing stocks in the coming weeks. The tariff détente story is still unfolding, but the direction of travel appears positive, which is supportive of risk assets broadly. Oil markets continue to add to inflation pressure. Crude prices are rising amid renewed tensions with Iran, contributing to the broader inflation picture that is worrying the Federal Reserve. Higher oil prices feed directly into transportation costs, manufacturing inputs, and ultimately consumer prices. This is a headwind that the Fed cannot ignore, and it reinforces the hawkish tilt we are seeing from policymakers. On the negative side for tech, Tesla announced a recall in China over safety concerns. This is a relatively minor event for Tesla specifically and does not change the broader tech thesis, but it adds to the narrative of regulatory headwinds facing American companies operating in China. Now, let us get to our 4 stock picks for today. Each pick is matched to a different investing philosophy, so there is something here for every type of investor. First pick, Cisco Systems, ticker Cisco. Cisco just reported earnings after the bell. AI orders surged, sending the stock up 17% in after-hours trading. This pick comes from the father of modern value investing, Benjamin Graham. He would be drawn to Cisco because it is a networking giant with an enormous free cash flow moat, now with AI-driven demand acceleration. Cisco generates billions in free cash flow, has a fortress balance sheet, and is a dominant player in enterprise networking, security, and now AI data center switching. The safety margin is substantial. Cisco is now clearly benefiting from the AI infrastructure build-out, with AI orders surging in the latest quarter. Data centers need switches and routers, and Cisco is the incumbent supplier. He would say buy quality at a fair price and let the compounding do the work over time. Second pick, Oracle Corporation, ticker Oracle, trading at $189.76, up 1.57% today. This pick comes from the legendary growth stock investor, Phil Fisher. He would be focused on Oracle's accelerating cloud momentum and AI-driven database demand. Oracle has transformed itself from a legacy database company into a genuine cloud competitor, and the market is only beginning to realize the scale of this transition. AI workloads require massive database infrastructure, and Oracle's autonomous database and cloud infrastructure are benefiting directly. He would say that when you find a company with a durable competitive advantage and accelerating growth, you should hold it for the long term and not trade around the position. Third pick, Eli Lilly, ticker Eli Lilly, trading at $1,015.75, up 2.61% today. This pick comes from the everyday stock picker, Peter Lynch. He would love Eli Lilly because it is a company whose products you can see in everyday life. Everyone knows someone on Mounjaro or Zepbound. The obesity and diabetes market is one of the largest addressable markets in the history of pharmaceuticals, and Eli Lilly is the clear leader alongside Novo Nordisk. Lynch would say invest in what you know, and what everyone knows is that GLP-1 drugs are changing medicine. Eli Lilly has a deep pipeline, manufacturing scale that competitors cannot match, and a brand that doctors trust. He would say this is a 10-bagger in the making for patient investors. Fourth pick, Micron Technology, ticker MU, trading at $803.63, up 4.83% today. This pick comes from the disruptive innovation investor, Cathie Wood. She would be drawn to Micron because it sits at the intersection of two of the most disruptive trends in technology, artificial intelligence and memory. Micron is the leading manufacturer of high-bandwidth memory, or HBM, which is essential for AI training and inference workloads. The DRAM market is in a structural upcycle driven by AI server demand, and Micron is the purest play on that trend. She would say that when a disruptive technology is in its early innings, the potential returns far outweigh the near-term volatility. Micron is not just a memory company anymore. It is an AI infrastructure company. Let me briefly address Ford since it was the biggest mover today, but we are not recommending it. Ford Energy is a legitimate strategic pivot that could unlock significant shareholder value over time. The grid-scale battery storage market is expected to grow exponentially as renewable energy penetration increases and utilities need more storage to balance intermittent supply. Ford's expertise in battery chemistry, thermal management, and large-scale manufacturing gives it real advantages in this market. However, the stock surged 13% in a single day, which means the market has already front-run the thesis. Patient investors should wait for a better entry point and treat Ford Energy as a multi-year catalyst rather than a next-quarter event. For stocks, for different investing philosophies, one common theme: quality businesses with durable competitive advantages bought at reasonable prices. He selected Cisco for its free cash flow and safety margin. He selected Oracle for its accelerating cloud momentum. He selected Eli Lilly for its dominant position in obesity and diabetes care. And she selected Micron for its leadership in AI memory chips. Each of these investors would tell you to buy with conviction and hold with patience. Markets are volatile, inflation is sticky, the Fed is hawkish, and the trade picture is uncertain. But the best time to buy great companies is when the macro environment creates confusion and opportunity. Do your own research, size your positions appropriately, and think in years, not days. I'm Chloe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.